Hey, Kevin here, top 1 financial advisor and best-selling author, and we are here to talk about the stock market. A lot of people are already calling for a crash of 2022, so I want to tell you what you need to know, what's real, what's probably a scare tactic, and what to expect more of for 2022. Now, first thing is, nobody has a crystal ball. Not even this guy who just consistently every month or so says it's going to be a terrible crash, everything's bad, buy gold, buy silver, buy Bitcoin. Robert Kiyosaki always says stuff like this. Don't use that as your base case for what is going to happen in the near future. But again, here's the danger with believing stuff like this. Is number one, it scares you, it distorts reality, and then sometimes it has you to wait on the sidelines. So in fact, if you go back and check out, please, actually, you don't want to go back and check out his tweets. However, if you were to do that, he was saying this in 2020 and then 2021 and then before then, and after, like every month or so, he puts out a crazy tweet like this. Here's the thing though. The market was up in 2020. Believe it or not, it actually was. We dropped 35% or whatever it was between March and April. And at the end of the day, the market was still up and was up almost 27% in 2021. Right now, the market is down about 1.5% or so, but we're only 10 days into the new year. That's it. It's been 6 days, 6 trading days, if I'm not mistaken, out of about 251 trading days out of the entire year. We are nowhere close to being done for whatever could happen this year, whether it be positive or negative. In fact, when it comes to crashes, and really just not even a crash, but in terms of the market actually being negative, it doesn't happen as many times as many people think. In fact, I want you to think about this before I give you the answer. How many times do you think the stock market was negative between 2021 and the year 2000? So we're talking basically 21 years. How many times do you think the stock market was negative? I'll let you think on that, and I'm going to give you the answer now. 5 times. That was it. That means the other 15 years between then, the market was positive. And so going all the way back to 2000, you had 2000, 2001, 2002. That was a dot-com crash. That was 3 years. That was a real crash, right? 3 years in a row that the market was negative. You got no crashes up until 2008. Things were fine for 10 years. The market was down in 2018, and that was it. 2019 we were positive. 2020, even though we had the coronavirus dip, the market was still positive at the end of the day. And then in 2021, the market is up close to 27%. So they don't happen often. We just had we recovered from a severe crash, a severe dip in 2020. It is rare, in my view, that you're going to see a repeat of that just 2 years later. They don't happen that often. That's why they are crashes. That's why they're anomalies. However, there are 2 things you want to know. Number one, that does not mean that every single thing in the market is going to go in the right direction or even go in the same direction. For example, prior to 2021, energy was one of the worst sectors that you could be investing in. I've done videos, you gotta go back to like 2018, 2019 or so, maybe even early 2020, where you talk about like, you got ExxonMobil, I wouldn't invest in that. Right? There are a lot of energy stocks that I would not even touch 3, 4, 5 years ago, because that entire sector was garbage. In fact, I think it was 2010 or so. I have to go back and look at the numbers. Around 2010 or so, it was like right now we see Apple as the $1 trillion company, the most valuable company, and like this is the bellwether company that you have to own. That used to be Exxon. That used to be Exxon, and that is not the case anymore. And you know that, right? Nobody is picking up Exxon stock like they do Apple today. But it was not always like that. It just shows you how energy had fallen off up until last year. Energy was one of the best sectors in the market last year. We'll see if that's going to continue in 2022. However, here's the thing. What you don't want to do, right, is overweight and not diversify and have all of your stuff concentrated in one place. So far, even though it is early, we expect technology companies, especially the new fancy technology companies that don't necessarily have the revenue and the backing and the cachet as an Apple or Microsoft or Google, that those are the ones who are going to be hurt the most. And these are the ones that you might want to avoid according to some. And I'm kind of getting on that train to a degree, and I'll tell you a little bit more about that. So there could be a case where the market does fine. Market does what it does, things are fine, except a good chunk of technology stocks don't do well. and energy is fine, consumer goods, consumer staples, all that kind of stuff does fine, which tells you as an investor, I say this all the time, is you want to be diversified, you want to have your money in different places. So maybe I've got some tech stocks, maybe I've got some defensive stocks, maybe I've got me some dividend stocks, and sometimes these can, you know, merge together in some cases. But because you don't know and I don't know and nobody has a crystal ball of this is what's exactly going to happen, you do want to spread yourself out so that in an event where, oh look, Square and PayPal for me absolutely crashed. I get an alert every 2 days about Square and PayPal hitting a new 52-week low, which is the worst it's been in the last year. That happens literally every other day. I get an alert that tells me that. I don't own them anymore, but I be keeping track anyway. But if that was all your money, if you had your money in, let's say, Square and PayPal and Affirm all at the same time, and I told y'all when I bought it, right? Go back to the video from December of 2020. December 2020. Go back to that video. And you'll see I say, I don't want to own Square and PayPal because I'm going to double my risk, and that I wanted to spread it out. So I had Square, my son had PayPal. The theory was one of us were going to be right or we're both going to be right. I didn't expect both of us to be wrong. However, instead of doubling the pain in my account or his, we spread things out. That helped us, right? But also, you know, the other thing that helped me, not having everything in just Square. I had my Microsoft, I had my Apple, I had my Capital Ones, I had my Targets, I had a bunch of different things that together represented a decent chunk of the entire stock market. That's where you want to be. The reason why people are not as confident for a lot of tech names is because of the rising interest rates. I think we talked about that before. Essentially, loans are going to become more expensive. If your company isn't making money, right? Let's take a Revlon for example. If your company isn't making money, you're not making a profit, you have to borrow and borrow and borrow and try to just push growth as much as possible, and then hopefully the revenue will come after the fact. That's the thought process for a lot of newer tech companies. How Amazon got there. Amazon was losing money for years before they became the Amazon that we have today. So if those loans and when those loans become more expensive, that hurts your future profits, and it really changes the way I look at you and how investors look at you as a future business proposition. Because if you're not making money now when rates are low and it's inexpensive, when they become more expensive, how are you then going to make money? That's a concern. And investors are saying, well, look, if you're not making money when money is cheap, when you're borrowing money cheaply, if it's going to get more expensive, I don't know how it's going to work out for you, player. That's what a lot of investors are saying. And we are expecting, and it's not a guarantee, but we're expecting 4 different rate hikes this year, which means the Federal Reserve is going to raise the price of money, which is interest rates, 4 different times in 1 year. And the expectation is when you raise interest rates, the stock market takes a step back and it's not going to grow in the same way. So that is the expectation. Now for me, I think it is going to bring down some stocks. Okay, that would be the hypothesis based on what we've seen in history. So I don't expect, again, a 27% gain or higher. If that happened, I would be shocked. I was shocked in 2020 to see that we recovered from a 35% dip. Didn't see that coming either. I invested the same way, right? But I would not expect that. If we do, perfect. Now, if the market is negative like it was in 2018 or 2000 or 2001, that's really not going to shake my faith in the market or anyway, right? Even though it is relatively rare, that does not change how I'm going to approach things for myself. The only people that I think should be concerned about a potential crash in the market are people who are going to retire or expect to retire within the next 5 years. You should be the most concerned because you want to make the most aggressive adjustments to your portfolio because you're retiring very soon. So you want to have more bonds, you want to have more, safer investments that definitely pay dividends in spaces and companies that aren't quote unquote speculative and aren't hope stocks. Like we hope that the metaverse is what we think it is, right? We hope that, this technology does all of these amazing things. You're not in that retirement. If you in that phase, that's not what you look for. That's not what you want. You want something boring that you know is going to work, that you know pays good dividends, that you know is going to be there, and that is entrenched in the market that's really not moving. So couldn't Apple fit? Yeah. You already know the stock I'm going to say, something like a Costco, maybe even a Pfizer. Maybe a Johnson & Johnson, although that one's a little shaky, but they pay good dividends. Home Depots, Lowe's, stuff like that's what you want. That's what you want. If you're that, 5 years in retirement range, you really want to take a look at how much you have in stocks compared to bonds. If you're not in that, I really don't care if the stock market crashed in 2020 or not, honestly, because I'm gonna keep DCAing and doing what I was doing anyway. So to me, I'd be looking at a discount, right? Because I know Microsoft's not going anywhere, at least not this year. I don't see Google going anywhere, or Apple, or a lot of the tech names that that most people would expect to drop. Nvidia, those are not going anywhere. Target is not going anywhere. I don't see Capital One going anywhere, right? I own some REITs. Like you see that as I'm approaching the market, I've already moved to real estate, right? We talked about that. I'm keeping something like a Target that is in a space where people have to shop anyway, right? You want to start to make those adjustments if you haven't already, in the event that the market doesn't do what we expect, okay? Because we've known the last, really 10 years or so, tech stocks were absolutely just blown out the water. The stock of the decade was Netflix at one point. Like that was up 600%, whatever it was at that point in time. That might not be the case in 2022. That might not be the case. Didn't say it is or isn't, but companies like Zoom, I bring that example up all the time, where one year was great, next year wasn't, 2022, question mark, right? I'm not looking for question marks in 2022 based on what I'm going to see from the rate hikes and inflation. And supply chain. Those are the three major things that are on investors' minds. And what you want to do is go for what we think is the sure thing and the things that you know. So if it is a speculative company because you expect the metaverse to do something, you expect, this niche technology to do something crazy, this might not be the time for that. So focus your time and go back to the other day's video when we talked about what sectors to look at. Look at those dividend stocks. Look at those healthcare stocks. If you find a company that you think is coming down for no good reason, then that might be a discount. But not all dips are the same. Okay? Not all dips are the same. Keep that in mind. Okay? There are companies that are dropping, like a Square and a PayPal, to bring that up again, I'm sorry, but companies like that, those are severe dips. Microsoft didn't do that, even though they're kind of in the same quote-unquote technology space. I wouldn't say quote-unquote because Square and PayPal are definitely technology, finance technology, but fintech, you get it. But in either case, all dips ain't the same, right? The dip that we saw in Nvidia the last few days is not the same as what we've seen in other spaces. So healthcare, financials, dividend stocks, defensive stocks, those consumer staple companies that we've talked about before, focus on those. That's not all the things you want to have, but those are some of the safer places that if things play out the way we expect, those are the places you may want to consider being, that are quote unquote safe havens and won't be as reactionary to what we think could happen in 2022. Again, it's still early. Y'all have been here for a while. Y'all should hit the like and subscribe button and stay here, right? And we continuously update these things as the year moves on. Once we hit March and we've hit that first quarter, we'll know a lot more than what we do today. Again, it's only been 6 days, okay? But we do expect the Federal Reserve to raise rates. That is going to impact the market, and those are the areas you do want to focus on. I don't really think it's going to be a crash unless you're 5 years from retirement. I wouldn't worry about it anyway. This is that time, right? This is that time for those who have been here long enough. You saw what happened in 2020. The market crashed, and people who bought and held on made a whole lot of money. People who bought and held on in 2008 made a whole lot of money. So if things fall this year, if you buy and hold quality, 2 years, 3 years, 4 years from now, you could have a whole lot of money. If things don't drop and things continuously move up and you're investing right now, you can still have a whole lot of money, right? So the key here is consistency. That's the key, because if you invested in 2021, at the beginning of 2021, you could have made 27%. If you invested in the beginning of, of 2020, you would have made 15 or so percent, whatever the double digit number was. You did this in 2019, you would have made that double digit return. So again, 2019, 2020, 2021, that's 3 years in a row of straight gains. And every time people thought, oh, it's the highest it's gonna get, remember in 2021, we hit a new all-time high 70 times. 70 times we hit a new all-time high. So just because you think it's overpriced, just because you think it's really high right now, it might not be, because you don't know what high is, right? And high is different 5 years from now than what it feels like today. So again, long-term investing, relaxed investing. Don't fall for the fear tactics, but also be smart. Look at what's happening in the market and place your money in places that make sense, and remember to diversify. All right, that is it for me today. Make sure you like and subscribe and share the channel with other people, because I've gotten a lot of great reception that people really love the videos and the content that makes sense, that is simple, which I like. But you gotta tell people about the channel. Like and subscribe. That helps the channel to get out there to more people, so we can help educate and build a good community of helping people to understand the market and to not jump out there blind and just be throwing money away. I don't want to see you do that. I want to see you build wealth, right? Together. All right, that's it for me. I'll talk to you guys later. Bye.